key indicators are flashing green right now. We know that GDP went up 6.4% in the first quarter, and jobless claims fell to 553,000, a pandemic-era low. I want to bring in Ted Oakley, Oxbow Advisors Managing Partner. Ted, how worried are investors about the Fed announcing yield curve control?
Well, Sibile, I don't think the average investor actually understands yield curve control. The average investor, they may have heard the term. But if you look at it also just on a normal basis and go back and look every week at the Fed, New York Fed, and that's where all the buys come in, you'll find that they're already doing quite a bit. They're buying 10-year, 20-year, 30-year maturities and TIPS bonds. They're buying everything. And so I'm not certain they're already, they haven't mentioned it and said it, but I think in reality, they're actually already buying maturities across the curve.
What's your take on what Fed Chair Powell had to say about inflation? Still saying it's going to be transitory. I mean, we keep seeing raw material prices go up, lumber prices, which we're going to talk about a little later on in the show, going through the roof, tacking on thousands of dollars to a home. That doesn't seem necessarily transitory to me. What's your take?
Well, on what he said, I have a take on that, and then one on housing as well. But on what he said, I think that what happens with the Fed is, unfortunately, they wait until they see the whites of their eyes, so to speak, like you used to say in war, and then it's too late on something like that. And I know they have this other word they use called tools. We have all the tools, and I'm not certain they have the tools right now to do what they need to do. And I hope they're okay on that, but actually, I doubt it.
And what do you mean by you're not sure that the Fed has the right tools? As soon as I heard that, I was like, wait a minute. Well, elaborate, please.
Sibile, he keeps saying, okay, like if we start inflating or everything, we have the tools. Well, the only tool they've ever had is to go in and raise interest rates. You can't raise interest rates with $30 trillion in debt. You can. If you take a stab at that, and then all the other debt that's tied to everything, then you're in a situation where you're a catch-22 in a way, and that if you raise rates to thwart inflation, then you break the back of the economy. And so, see, I don't think they have the tool. I'll just give you one example. Volcker back in 1982, he pushed rates, he broke inflation. But we were only about, 20, 25% debt to GDP. Well, we're 120% now. So it's a different game. And so I think that's what's missing on all this. I don't think they have the tools to do that unless they bring something new.
All right, well, then let's talk about that, because you're making it sound like the Fed may be, sort of inconsequential amidst all of this. I mean, should the Fed be moving sooner rather than later? Is that the answer? Is the answer incrementally raising interest rates now, or are you saying that would just strangle the economic recovery?
Well, I think what's happened on it, Alexis, is they backed themselves in the corner. They had the chance back when Yellen was in. That was their chance really to get back and normalize interest rates. They passed on it, kept on funding, and now they're at a point where there's so much out there that one of the things they'll have to do is really try to determine how they want to impact that. Because I think they're so far down the road now that you can't get back to a normal situation the way we are now. And if you remember, between 1945 and the early 80s, what happened was you inflated more than your interest rates, and that's why we got back in a situation of debt to GDP was okay. And I could actually see that happening. I think that's the way it will end up going eventually.